Hi, and thanks for tuning in for this quarter's Student of the Market Update. My name is Sean Bjork, and our role is to serve as the independent investment fiduciary advisor for your organization's workplace retirement savings program. And as always, the goal for this series is to help with the important financial decisions you're making, not only in your workplace retirement savings plan, but beyond. So with that, let's get started. Thanks for tuning in. We're going to stick with the prior quarter's format. Got a lot of good feedback, so we're going to go greatest hits, 4 slides, keep it under 5 minutes, and here we go. So to kick things off, let's look at how the markets have performed throughout the first part of the year, now that we're in the first quarter of 2024. And we've had a positive January and February. What has history shown us that could look like for the rest of the year? Well, history has shown us, if we start the year off well, that historically that has boded well for investors throughout the remainder of the year. So interesting to see if that plays out in the current year. And given that we have an election cycle coming up, there's plenty of noise sure to be headed our way, but interesting to see how that'll play out. So along those lines, when we're looking at the equity side of the equation, volatility has remained relatively low. So if we look at volatility year to date, we can see that building on 2023, we've been in a period of relative calm for the markets. And so, when we look at the chart, we see volatility tends to come in waves, as does that relative calm. And if we look again at the chart on the right-hand side, we can see that the market has tended to like that calm. That's been, boded really well for investors. That's something that, again, it'll be interesting to see how that plays out this year. But certainly the market has historically rewarded investors during those periods of relative calm. So let's flip the coin. Let's look over to the income side of the equation. And with interest rates edging higher, we have seen the income being put back into fixed income as well as cash. And so speaking of cash, we look and see at the chart on the left, we can see that investors have poured money into money market funds at an impressive clip. And if we think on a relative basis to what cash was returning even a few years ago, it does look attractive relative to prior yields. However, there's a reason it's called the cash trap, right? And so if we look at on the other side of the chart here, if we look at how bond mutual funds and ETFs have performed relative to money market funds, and specifically relative to the 4.7% average rate of return for money market funds last year, we can see that 84% of bond and ETF funds have outperformed and surpassed that hurdle. So just something to think about. If we're a long-term investor, cash has a lot of purposes, but long-term wealth creation historically has not been one of those purposes and strengths. So when we, if we look at our retirement savings portfolio, if we see we're really heavy in cash or even our investments beyond, give us a call. That's our job. My team and I are happy to walk you through that and look at that asset allocation and see if potentially there are some opportunities to revisit those asset allocation decisions. So with that, let's look at that same question, but let's go ahead and compare a traditional 60-40 portfolio, which is what many retirement plan investors hold, or something very similar. How has that performed relative to cash? And specifically, if we look at this chart here, we look at the likelihood of cash outperforming a 60-40 portfolio over different time periods. And if we see even the best case for cash on the 1 year, those aren't great odds, not ones that I would take. But if we extend that time horizon, you see it really falls off a cliff, right? And so when we think about if we're a long-term investor, what has history shown us? Has been the right way to think about asset allocation over long periods of time, and what has that done relative to cash? And we can see that the likelihood of cash outperforming a balanced portfolio over these different time periods is increasingly low. Now, on the right-hand side of the chart, if we look and see not only the likelihood of that cash outperforming, but what's the magnitude of the underperformance of cash relative to a 60/40 portfolio. And we see really that same relationship, right? The longer term investor we are, the more likely it is that there's a significant underperformance for cash over longer periods of time. So, when we look at these, both of these last two charts, the important takeaway is that there is a role for cash in a lot of portfolios. However, if we are a long-term investor, it's just really important to be mindful of how much cash we have in that portfolio, and that we're being very specific about the purpose for that cash in our portfolio. So again, something to think about. And if you find yourself, saying, hey, I'm pretty heavy on cash at the moment, as we saw those flows may suggest, track us down. That's why my team and I are here, and thrilled to have that conversation. So with that, we're done. Thanks so much for tuning in. While we put some important disclosures up on the screen, just a quick opportunity to thank you again for taking the time to become a better student of the market, and to reinforce, please feel welcome to reach out to my team and myself to have those conversations. That's why we're here. That's what our role is, and we're thrilled to help support and help with those important financial decisions in your workplace savings plan, and for your financial future and your goals beyond the plan. So thank you so much for tuning in, and look forward to seeing you next quarter. So long.